Risk, incentives, consequences, haze mind, the hidden economics behind big decisions.
Some of the worst financial decisions in history were celebrated as victories on the day they were made. And after more than 20 years assessing risk, I've noticed something strange. The investments that lose the most money rarely begin with fear. They begin with applause. A ribbon-cutting ceremony, a booming housing market, a beautiful new neighborhood near the water, a dream home surrounded by forests. Because risk rarely looks dangerous when times are good. It looks affordable. It looks exciting. It looks normal. Insurance was supposed to make life predictable. You pay a premium. The company protects you from disaster, and you hope you never need them. For generations, that simple arrangement helped make the American dream possible. Families bought homes. Businesses expanded. Banks issued mortgages. Communities grew. Insurance quietly stood in the background, making all of it possible. But something has changed. Across America, insurance bills are exploding. People are opening renewal notices and finding premiums thousands of dollars higher than they were just a few years ago. The obvious explanation is that insurance companies are charging more. But after 2 decades working in risk management, I've learned that prices often tell a deeper story. Because insurance doesn't create risk. It measures it. And what those measurements are telling us may be far more important than the bill itself. Welcome to Inside Haze Mind. Let's audit the system. Insurance is one of the most important financial inventions ever created. At its core, insurance is not really about money. It's about uncertainty. Imagine a neighborhood with 1,000 homes. Most will be fine. A few will experience tragedy. Insurance works because the many protect the few. It became an invisible foundation of modern life. When we look at the data, the numbers tell a story that is difficult to ignore. According to NOAA, the United States has experienced over $400 billion weather and climate disasters since 1980. For most of that time, we saw only a few such events per year. Today, that number has surged to over 20 per year. What makes this trend so important isn't simply the frequency. It's the concentration of value inside those disasters. 50 years ago, many vulnerable areas contained far fewer assets. Today, those same regions contain expensive homes, businesses, and entire communities. The storm may be similar. The financial damage is not. As exposure increases, so do potential losses. Higher property values, higher repair costs, and ultimately, higher premiums. But there is a hidden layer, reinsurance. Think of it as insurance for insurance companies. What most people don't realize is that insurance is no longer just a product. It has become part of a much larger financial system. Increasingly, global capital, hedge funds, private equity, and massive pension funds are pouring money into the insurance market. They are betting on catastrophe. They treat disaster risk like a stock, buying and selling what we call securitized risk. This effectively turns your neighborhood's vulnerability into a quarterly return on a balance sheet in London, Zurich, or New York. When global losses hit a volatility spike, the pressure doesn't just stay in the local insurance office. It trickles down instantly to your renewal notice. This creates a feedback loop that most homeowners never see. As insurance gets more expensive, local property values begin to adjust. If a home costs $500 a month to insure, it's worth a certain price. If it suddenly costs $2,000 a month to insure, that property value drops. That means the local tax base shrinks, which means the city has less money to spend on the very infrastructure, the levees, the roads, the emergency services. That was supposed to keep the city safe in the first place. It is a slow-motion downward spiral. We have spent 50 years building in high-risk zones, as if we were immortal. From a risk management perspective, we didn't just build homes, we built liability magnets. The industry is essentially saying, the geography you chose is no longer compatible with the price you want to pay. This is leading to the rise of insurance deserts. Entire communities are being redlined, not by banks but by actuaries. If you live in an area that insurance companies deem uninsurable, your home value doesn't just stagnate. It effectively dies. You cannot get a mortgage without insurance. If you cannot get insurance, you cannot sell. You are essentially trapped. Let's make this real. Imagine a retired couple living near the Florida coast. Their home had become more valuable, yet somehow living in it had become less affordable. An asset that looked richer on paper. A life that felt poorer in reality. This is one of the strangest consequences of inflation. People can become wealthier on paper while feeling financially weaker in daily life. Their property value rises. Their insurance rises. Their taxes rise. Their maintenance costs rise. Eventually, the asset they worked so hard to own demands more cash every year simply to keep it. Consider California. People paid a premium to live near forests and mountains. But what happens when affordability becomes an insurance problem rather than a mortgage problem? What happens when the house isn't the issue, but the risk attached to the house is? In finance, we call it the sunk cost fallacy. Families pay the higher premiums and cut spending on everything else, on education, on healthcare, on retirement. They are becoming house rich and cash poor. They are effectively paying a premium to live in a house that the market is already trying to abandon. It is a slow-motion exit from the middle class. Insurance premiums are not simply bills. They are signals. And like most signals, they are easy to ignore until they become impossible to avoid. Here is the uncomfortable possibility. Insurance may be one of the first industries pricing future risk in real time. Not next year's risk. Future risk. Long before a city changes. Long before property values adjust. long before public policy responds. Insurance markets are already making decisions. They are deciding which risks are acceptable, which locations remain affordable, and which assumptions about the future no longer make financial sense. Most people won't notice these decisions until years later. And when markets begin pricing risk before society recognizes it, the consequences take years to fully appear. We have to understand that this isn't about blaming insurers. It's about recognizing that the price of risk is now the most honest indicator we have. For decades, we relied on historical data, assumed the next 50 years would look like the last 50 years. But the market has stopped looking backward. It has started looking forward. And what it sees is a world where uncertainty is no longer an anomaly. It is the new baseline. The story of America's insurance crisis is not really about insurance. It is about risk. It is about incentives. It is about what happens when long-term trends collide with economic reality. Perhaps the real insurance crisis isn't that premiums are increasing. Perhaps it's that the risks behind those premiums are becoming impossible to ignore. Because insurance doesn't create risk. It measures it, prices it, and sends the results back to us. After 20 years assessing risk, I've learned something simple. Headlines tell us what people are paying attention to. Markets tell us what people are pricing. And insurance may be telling us something about the future that many of us still don't want to hear. And perhaps the most important risks are not the ones we insure against, but the ones we spend years pretending aren't there. Thank you for listening. If you enjoy deep dives into the hidden economics behind major events, public policy, risk, and the long-term consequences of financial decisions, consider subscribing to Inside Hayes' Mind. And I'd like to hear from you. Has insurance become a financial burden for your family, or do you believe rising premiums are simply the new reality? Leave your thoughts below. Until next time, keep questioning the obvious.